Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. All right, I have my all-time list of overeducated guests, and our next one is certainly on this list. Okay, so Kristina Hooper, Chief Global Market Strategist for Invesco. Undergraduate degree from Wellesley. That's good. I have a lot of respect for that. Then she gets a master's in industrial relations from Cornell. Not sure what that is, but I know it's good. MBA from NYU. Okay, I think we're overdoing it there a little bit. And then, not only on that, she gets a law degree from Pace University.
Oh my God, a law degree? I did not know this.
I did not know that either. So
I knew she was the smartest person I talked to.
I know, exactly. So we appreciate getting a few minutes of Kristina Hooper's time. Hey, Kristina, what did you make of yesterday's trading? Was it just kind of the market kind of blowing off some steam here? What did you make of that?
I think there are a lot of jitters right now. And I think a lot of it has to do with psychologically the fact that now markets are very confident that the Fed is going to cut. Bad news becomes bad news. You've heard it before, but it really is true. And so any signs that this economy is weakening more than we had initially thought is cause for a sell-off, especially among stocks that are more closely priced for perfection. And that really is the story that we saw yesterday, and we may very well see it again today.
So it's a bad news is bad news situation when it comes to economic data and then the equity market, but it's still a slowing, not a downturn, right? So I'm trying to understand the distinction then when we do have some sort of big equity move.
Well, it is a slowing, but keep in mind, we don't exactly know how this monetary policy tightening plays out because of the long, variable, lagged effects of monetary policy. And so that is the underlying fear that gives markets pause and jitters when we do get, for example, a disappointing manufacturing PMI, or we see earnings warnings from companies, or whatever the case may be. So I think that right now markets are walking on eggshells. And we could very well see this leading up to the Fed's meeting, and again as we lead up to the election. So this should be, I think, a more volatile fall, one where there's more downside potential. But I think ultimately we end 6 months after the start of easing. I think we end in a better place because that is an environment that's supportive of risk assets.
In the near term, Kristina, how are you positioning, or how are you suggesting to your portfolio managers at Invesco that they position themselves for, I don't know, the next 3 to 6 months, where, as you say, there may be some volatility?
Well, I think there has to be, what we've been saying to clients is it's really important to have diversification. Sometimes you can look at periods of time and decide it doesn't make sense anymore to be well diversified among equities, fixed income, and alternatives. But this is a reminder that diversification helps to smooth out volatility. And so having that exposure outside the U.S. In the equity space. And keep in mind that there are many, many investors who probably are overweight the U.S. simply because they're not rebalancing frequently enough. And we've had such a strong run-up. There are many clients that are likely overexposed to large caps versus small caps, overexposed to growth versus cyclicals, overexposed to equities versus fixed income and alternatives. So this is an opportunity, I think, or a reminder at least, to be well diversified, but also don't be afraid of equities. Don't be afraid of risk assets. I look to 95, 96 as a guide. That was the last time the Fed was actually successful in avoiding a recession when it tightened. Now, there are some conditions that are very different than they are today. But my key takeaway is that easing provides a tailwind for risk assets. Now, there wasn't much of a tailwind in 95, 96 because the Fed only gave 75 basis points in cuts after hiking rates 300 basis points. We're looking out on expectations around 200 basis points in cuts over the coming year. So we could have a far more powerful engine, far more fuel to support risk assets this time around.
I have a question. Which degree did you like getting best?
I actually loved getting my MBA in finance. That was my sweet spot. And I love TAing. I did it at night while I was working during the day, and I found it to be a virtuous circle.
Half of Wall Street has their MBA from the Stern School at NYU, I'm convinced.
Yeah.
I mean, it's unbelievable
Not you,
what a
though.
program. No, I went to Duke, but they have a just fantastic program. Kristina, what do I do here with fixed income? Do I sit with my 2-year Treasury at close to 4%, or do I try to take some credit risk?
So I think you do both. In the spirit of diversification, when I look at the numbers, for example, in that 6-month period after the Fed began easing in 95, high yield did very well. But I believe very strongly that history can often rhyme, but it's not repeating itself. So in my opinion, I think it's important to have some exposure to investment grade. And I also think there's a place for treasuries. I would go longer duration in this environment, locking in these higher yields. But this should be an environment in which we could see a variety of different asset classes perform well, as we did in that 6-month period following the Fed's start of easing in July of 95.
All right, Kristina, thank you so much for joining us. Kristina, we always love getting a few minutes of your time. Kristina Hooper, she's the Chief Global Market Strategist at Invesco. Politics, the election, it's here. I think
that's
we
happening?
got like
Is that a thing?
63 days to go or something. I think it's important for global Wall Street, so let's try to figure out what it means for global Wall Street. Libby Control, she joins us. She's a managing director, head of public policy for PIMCO. She joins us here in our studio in New York City. Libby, you were just mentioning how you've been traveling all over the place talking to PIMCO clients. They want to know what you think about the election, maybe what it means for markets. What's been your message?
Yeah, so I would say particularly our non-U.S. clients are really interested in both the election, but obviously in implications, particularly implications for debt sustainability, for the U.S. dollar, and then for taxation. And I think what we've been telling them, is that they really needed to wait until after September, because that's actually when the polling starts firming up. It becomes a lot more predictive in terms of kind of providing some clarity in the race. Now we are in September and there is no clarity. I will just say, I think our message to clients now is that this really is a jump ball. It will likely come down to those 6 swing states that everyone has been reading quite a bit about, particularly Pennsylvania. Pennsylvania is the most important state in our view. There are some themes, though, that sort of regardless of the election outcome are going to be common between the candidates. One is that the deficits are going up regardless. Mm-hmm. And that's because the Trump tax cuts on the individual side all expire at the end of next year. Maybe some of them are going to be paid for if they are extended. We assume they will be extended, but most of them won't be. And so that will add to the deficit. And then also importantly, and I think people sort of forget this, but if you just look at sort of the base case scenario under the CBO's estimate for the nonpartisan budget scorekeeper in Washington, I mean, deficits are just structurally high because of entitlement spending, because of Medicare, of Social Security. These are really important programs, but they're also really expensive, and neither candidate is going to reform those. So I think the main takeaway here is deficits are going up regardless of who's actually going to win. And then we also think the direction of travel on tariffs is also clear, and export controls and sort of some of this protectionism. Of course, there are going to be shades of gray. Trump most likely sort of more draconian than Harris, but still, again, direction of travel here is clear.
Do you think that any of this is yet reflected in the market? I keep obsessing about the low tax and high tax companies to see if there's something there within this, and just nothing.
I would say that the only time we really started seeing this actually priced in the market was that very short period of time in early July when it did look like after the debate and after the assassination attempt of former President Trump, that the odds would be a red Republican sweep. That's when you started seeing sort of the term premium reinsert itself in the U.S. yield curve. You started seeing some of the sort of sector differentiation, but all of that basically has kind of collapsed, has gone away effectively as this race has basically tightened and gone back to really where it was in the spring, which is again just a jump ball.
How about down ballot? What happens to two houses of Congress? What's the thinking there?
Yeah. Well, so, and I used to work in Washington. I used to work on the Hill. So I have a bias towards really focusing our clients on the importance of Congress. But I really think from an investor's perspective, what happens down ballot is just as important as what happens at the top of the ticket in many ways, particularly from a fiscal policy perspective, tax and spending. Again, I think it's going to be very close. This is really unsatisfying, I realize. And we're not just trying to punt on not making a call. I really do think it's going to be very close.
And by close, we're talking about the Senate?
The Senate and the House. Okay. I think that the Senate right now controlled by one vote by Democrats. The Senate map for Democrats in terms of the number of seats that they're defending, much more difficult than for Republicans. And so very likely, possible that the Democrats hold their majority, but unlikely at this point. So likely that the Senate flips, but again, by probably just one vote. So that actually has implications in 2025. And then the House, again, maybe the House flips from Republican control to Democratic control, but regardless of actually who wins, it's going to be a very narrow majority. And what we have seen this session of Congress is that when you have a narrow majority of, particularly when you have divided chambers, but even if you have a Republican or Democratic sweep, it is just difficult to get a lot done.
So exactly.
Exactly. Yes.
So then to that point, does it even, I'm going to get a lot of hate mail from this. Does it matter who's in the White House?
I mean, it does matter, and particularly, I just can't underscore. Everybody just needs to buckle up for next year. It is going to be a tax palooza, if you will. There will be because of all of the individual tax cuts on the Trump tax cuts from 2017 expiring at the end of 2025. Everything is going to be on the table. Mm-hmm. The corporate tax rate is going to be on the table. The child tax credit is going to be on the table. Carried interest is going to be on. I mean, everything. So there will be a lot of headline risk. So it does matter because a lot of those things will go the way of the White House in terms of ideology. But outside of that, Alex, and this is what we're sort of guiding our clients to, is outside of the debt ceiling, issue, which will be an issue, sadly, early next year.
It's always an issue,
I know,
right?
I know. Yeah. Unfortunate, especially if you're a debt investor. And then also tax. I just don't think Congress is going to be able to get very much done, again, regardless of who's at the White House. But the White House does matter, as it relates to many other things outside of fiscal policy, but from a tax perspective, it does matter.
Are our elections going to be this close, like forever? I mean, it seems like the last couple elections have been, you're counting votes, like starting in 2000. Mm-hmm. Is that kind of where the new world is today? I
mean, it's possible. I think it's really difficult to prognosticate this sort of as super secular, but because of the geographic sort of self-sorting that we've seen in the United States, it has become, and because of our sort of highly polarized nature, it has become, very close, particularly at the top of the ticket. And I do think that will likely continue. I mean, if you just look, since the 1980s, just the number of elections where one candidate has won the popular vote and the other candidate has won the electoral college vote. I mean, it's really quite sort of staggering, and that is just because of sort of the kind of polarized nation of our country. The Senate and the House, I think, are quite a little bit different. The Senate, in particular, just because that is more predicated on which seats are up and sort of the Senate map. But in terms of the top of the ticket, I think this is probably likely to.
But even with the House
constant.
and Senate, it's still going to be, well, not right Senate, but the House is zoning, it's all redistricting, right?
Yeah.
Like it's still all.
Yeah, redistricting happens once every 10 years, and we just went through a redistricting period, so that won't happen for another 10 years. But the people are, the way that state legislatures are drawing these districts more blue and more red. But I think the upshot here for investors, maybe the silver lining, is actually that this isn't such a bad thing, right? I mean, I think that usually if you just look at how the S&P has fared since 1933, the market actually does better under divided government, under very narrowly controlled government. And that's, of course, that sort of intuitively makes sense, right? We like checks and balances, and so does the market.
All right. We got 63 days to go, more or less. Libby Control, thank you so much for joining us.
Good luck, Libby.
Libby Control, who's a managing director, head of public policy at PIMCO. All right, my finance professor, Cam Harvey at Duke, he penned this paper about the inverted yield curve leading to recessions and all that kind of stuff. I don't know. We've had an inverted yield curve for like a couple of years now, it seems like. Although today, the 3.85%, the 10-year, 3.83%. So it's kind of uninverted or kind of flattened. I don't know what the bond geeks call it. I'll ask Lisa Abramowicz
It's almost
later.
disinverted.
Disinverted.
There you go.
I like that. Very good. Andrew Szczurowski, he does this stuff for a living. He is a senior portfolio manager, Morgan Stanley Investment Management. Hey, Andrew, what does it mean to you, if anything, that this yield curve, as Alex just told me, is kind of disinverted right here? Does that mean anything to you?
Yeah, look, I think it's the market kind of sending a signal that the Fed's about to kind of embark on this easing policy. You know, I myself have never kind of been a believer in the inverted yield curve being a kind of predictor of recessions. I think there's been a lot of distortions over the last couple of years between monetary policy. We had kind of QE and then QT and just a kind of a ton of supply at the front end. So I think that the inverted yield curve this time doesn't send the same signal that it's sent in past cycles. But I think the one thing that's been happening, as you mentioned, the curve's been uninverting, and that's been sending investors a signal that, hey, you can actually go out the yield curve now without giving up that same yield that you would have just a year ago or so. So I think that as you extend out the curve, it's getting more and more attractive. And I think that's something that investors should be looking to do with the Fed about to embark on this cutting cycle.
With the Fed about to embark on a cutting cycle, what do I do with my money that's yielding still about 5%?
Yeah, look, there's over $6 trillion that's sitting in money markets. And that's money that, again, not all of it's going to move out the curve. But if you stayed in that money market fund over the next 16 months and the Fed cutting cycle played out as the market's expecting, by the end of 2025, you're looking at a 3% T-bill rate. And by March of 25, you're looking at a 4% T-bill rate. So while you collect that 5.25% today, if you just go out 6 months or so, it's going to be dramatically lower. So I think you do want to be moving out the curve. I think there's a lot of places that you can still lock in. If you like that 5.25% yield today, you can actually lock in over 5% yields without taking any credit risk by going out into the agency mortgage-backed security market. So again, AAA government agency yielding north of 5%. That's a place that investors should be kind of moving to, even if they're worried about a recession. This is a kind of a natural place to go. The other nice thing about extending out the curve is that bonds, once again, as inflation declines, acts as a hedge on your risk portfolio again. And we're starting to see that. You saw it yesterday as equity sold off, bonds rallied. I think that's something that when inflation is moderating, bonds kind of fit in that balanced portfolio much better again.
So I'm just looking at the Bloomberg U.S. MBS index total return, about 3.8% year to date. But I can do a lot better than that in the U.S. corporate high yield market. How do you think about high yield versus maybe, again, some of those mortgages that you were talking about?
Yeah, look, I think that there's kind of, when you look at spreads in high yield, the aggregate spreads are a bit tighter when you look on a kind of historical average. But you got to be, as I mentioned, I think that we're heading for a kind of a shallow kind of slowdown in the economy here. So I think this is a bond pickers market in the high yield market. I think you got to be selective. You know, we think that at the end of the day, you want to be kind of up in quality in that market and wait for spreads to widen out. We just had a kind of dramatic tightening over the last couple of weeks. And then we just saw spreads widen out about 17 basis points yesterday. So I think there's going to be opportunities to kind of move more into the high yield market. You know, I run a multi-sector fund. Right now, we're a little underweight high yield, but it's a space that we're looking to kind of add on dips. And it's a space that we think will remain attractive as yields come down. That's going to be great for kind of companies that are borrowing and have to kind of roll over this debt. But it's something that, again, you got to kind of pick and choose over time kind of where to add. And we think that's a space that will get more attractive as the year goes on.
What's so interesting in August is when we saw the meltdown in equities and that spike in VIX, we saw a little bit of widening out in credit spreads, but not a lot. Not that we'd normally see with a jump in the VIX like that. Are we still seeing it this time with the rollover in equities and the jump in the VIX?
Yeah, I mean, look, we saw it yesterday. And as you mentioned, we had the high yield spreads widen out to almost 400 basis points, and then they tightened into around 325, and then they widened out around 17 basis points yesterday. So I do think that credit markets will move with risk assets at the end of the day with the equity market. But I also think that at the same time, it's if you're a corporation and you had termed out your debt, let's say in 2020, and you issued a 5-year bond, you have to roll that over in 2025. So I think that lower yields are not lower yields are not actually a bad thing this time for corporations. It's going to be something that they're going to use to take advantage and kind of term out that debt once again.
So, Andrew, what do you guys at Morgan Stanley Investment Management, what do you think, or how do you think the Fed's going to proceed here? Are they going to front load some of their rate cuts here? Or are they going to be, I guess, more systematic, 25 basis points every meeting or every other meeting? How do you think they're going to do this?
Look, I think that the JOLTS number today is going to be very telling. And even more important is the payroll numbers on Friday. I think the payroll number is going to tell you 100% whether the Fed's going to go 25 or 50 basis points. If we get a weak number, all of a sudden, right now there's about a 40% chance priced for a 50 basis point cut. But the Fed is shifting from a inflation, like a single mandate on inflation over the last 2 years. While they have this dual mandate, they've been solely focused on inflation, to all of a sudden solely focused on the labor market, because inflation's coming back in order. And the one thing that the Fed wants to do is have this soft landing. And so the Fed knows that they're well above neutral. So the Fed's at that kind of 5.25% to 5.5%. At the same time, core PCE has come down from 5.6 to 2.6%. So there's been about 300 basis points of net tightening from as far as the Fed's concerned. So the Fed needs to kind of get going. And at the end of the day, the market, the Fed's policy operates with these long and variable lags. So anything the Fed does today won't have an immediate transmission through the economy. It's going to take some time. And so the Fed's turning this giant ship. It's going to take a while to turn it. I think that when you look at what's priced in for the market, so around 9 cuts total for the cycle, that still puts the Fed funds rate north of 3%, which, keep in mind, the last hiking cycle, we only hiked at 2.5%. So even if we are in a higher neutral rate environment, which I'm not convinced that it's substantially higher than where we used to be, I think at the end of the day, we're talking about where neutral is. And if we have a slowdown, the Fed's going to go through neutral and below neutral. And that's where the value proposition is in bonds.
All right, Andrew, appreciate it. Thanks a lot. Andrew Szczurowski, Senior Portfolio Manager at Morgan Stanley Investment Management.
All right, your daily look at the front pages around the world. All right, what do we got here? In the newspaper segment, Lisa Mateo, I know you've got some good stuff for us. What do you got?
We do. Okay, so remember we were talking yesterday about Vice President Kamala Harris said U.S. Steel should remain domestically owned and operated. Well, the Financial Times had this report out. It's reporting that Japan's Nippon Steel has made this pledge to promise the company would be run by Americans. So a few things that it promised. It pledged to appoint a board for U.S. Steel with a majority U.S. citizens. It said the board's going to include 3 independent directors who are U.S. citizens, and that core senior management members would be American. But here's another thing. It also said U.S. Steel would be owned by Nippon Steel North America. So that's a New York-based subsidiary of the company. But then you have the Wall Street Journal now coming out saying U.S. Steel CEO saying the company could close steel mills, likely move its headquarters out of Pittsburgh if that sale to Nippon Steel collapses. So all these things kind of coming together after what Vice President Kamala Harris said.
They lost money for like a decade, U.S. Steel, right? Higher costs, lower prices for steel. Like it's a commodity cyclical business, and it is really hard.
Other than the name United States Steel, it's only an $8 billion market cap company. I get the name, I get the affinity, I get all that stuff, Pittsburgh Steel, but economics are economics, it seems like.
Now, the difference is that Cleveland Cliffs has also offered a deal for U.S. Steel, but it wasn't as good as Nippon Steel. So you just wonder if, Harris campaign and Biden is going to talk more about that now.
It just seems political. We'll just let it.
Exactly.
The day after the election, neither side will care. Just let the deal happen.
I think that's probably true.
Economics.
Yeah, I'm like sure.
All right, what do you got?
Do you guys carry around these?
I don't like this story, and I don't want to talk about it.
Yes, we have to talk about it.
No, we do not.
Yes, okay, it's in the Boston Globe.
I have one of those.
So you carry around these reusable water bottles, right? But they're infested with bacteria because you have to think about how. I think I wash it once a week. That's so bad. I'll pop it in the dishwasher.
Okay, no, this starts.
But how do you wash it? You need a little tiny baby hand.
Yes, or you need the little brushes. So the Boston Globe laid out a plan for you, what to do. So they say one of the things, the Stanleys, some are dishwasher safe and some aren't, and that's the most popular one. So some people are popping it in the dishwasher. You really shouldn't. So you need the little tiny brush to wash it every day. They say you should wash it with soap
this
and
goes
water every
way
day.
Deeper than how you clean it.
Yes.
Why do you even have it? When I was growing up, if you were thirsty, you got a drink of water.
Okay,
you didn't have to hydrate.
Hydrate.
Do you not know me but at all? Do you not see how much water I drink?
I know, but it's the kids today, they've got these huge things sitting at their desk, and they're hydrating. The water fountain's literally 3 feet away. Why do you have this jug of water
because
at
you
your
have
desk.
to keep track of how much you're drinking.
No, you don't.
You
if
have
you're
to drink.
thirsty, then you drink some water.
Okay.
That's how it works.
If you are also taking a mountain of pills and
See,
have
with the-
esophagitis like I do,
Oh,
you need a whole
esophagitis?
glass of water with every pill you take. So I down like those like 2.5 liter bottles when I
nother
take my
discussion.
pills.
All right.
This is a whole other discussion.
Very good. Yeah, don't get me started on these.
You have to
on the water.
half your what is it? Half your body weight in ounces. That's how much you're
It's
supposed
always
to
been that way. So what have we done since the beginning of time? When you're thirsty, you drink some water. There you go.
You can overhydrate though. I read that that's a thing and it can actually cause a physical reaction that's not good. But you can OD
Okay.
on water.
Boy, this is
just the right amount.
very good.
Okay.
Next.
Taylor Swift. I don't know if your daughter's a fan.
Yes.
Okay, there we go. Okay, so this is the thing. The Dodgers' Shohei Ohtani could have that Taylor Swift effect because, he joined the Dodgers this season, $700 million deal, right? But tourism officials telling the Wall Street Journal he's bringing visitors to Los Angeles as far away from his native Japan. Omni Los Angeles California Plaza, they've been seeing bookings for Japanese visitors jump 30% this summer from Expedia alone.
Wow.
He's made the Dodgers this hotter ticket on the road too. So on the road, people are going to travel to go see. Tour operators are selling packages featuring Dodgers games. And then, if they're in first place in their division, they now get ready for these playoff package getaways. So all this different money kind of going into all the talk about Shohei Ohtani.
I bet that's cheaper than Taylor Swift tickets. Right?
Yeah,
Could
and
be.
Here's the East Coast bias. I haven't seen him play. I'm a baseball fan. I'm going to the Yankees next week. I haven't seen him play. I mean, if you're on the West Coast, you might as well be, you're just, nobody cares, it seems like. But again, Shohei Ohtani here, I know he's huge, and he's a once-in-a-lifetime kind of Babe Ruth kind of player here.
Hitter,
But
pitcher, yeah.
boy, if he's on the West Coast, I need to pay more attention, I think. All right, move over Taylor Swift. All right.
I know.
doubt it.
I don't know if
doubt
they're
it.
going to be doing
Unless
Shohei
it's
Ohtani.
$2,000 tickets
All right,
in Miami.
so as per Ari from the bleachers, Shohei is closing in on the first 50 home run and 50 stolen base season ever.
Oh, see,
So how amazing
even
is
more
that?
of a reason.
Exactly. All right, I'll
Even
pay
more.
attention.
I don't know if he's getting the friendship bracelets though.
That's
We'll
true,
have
and
to see about
can you
that.
trade them?
Yeah.
I don't know, guys. I don't know. All right, what else are you looking at?
Okay, are you drinking less wine these days? I don't know if you guys were like wine drinkers, but you're switching it up. You are.
I'm into the Barbaresco now. We've been pouring that recently,
so
the
good.
Nebbiolo grape.
I mean, I drink a lot less than I used to. Let's just put a lot.
You are.
a
Yes.
lot less than I
totally-
used to.
Yeah.
Is that another issue we need to discuss?
Yeah, exactly. We'll just rack them up. We'll rack them up. They're all
We
probably
got the
related.
water bottle.
Well, here's the thing: because people are doing it, Constellation Brands, they're warning that they're going to write down the value of its assets by as much as $2.5 billion this year. So, I mean, they make Robert Mondavi wine, but they also do the beer, Corona, Modelo. They do those too. They say beer not as well too, but they're saying inflation. Consumers are pulling back. They're saying wine is not an essential item, so people are pulling back.
I wonder if it's also like
from
the
that.
post-pandemic. Did people drink more during the pandemic because they
I
were
think
locked up?
yeah.
I remember seeing
yes,
those
we
stories
did.
back
Yes,
in
we
the day.
Yes, we did. What else was there to do?
Exactly. And now people are out and about doing stuff. Maybe, I don't know.
Yeah, and then people are getting like a little bit more health conscious. Like wine has more sugar and more like.
Well, what
different
everybody's
things.
drinking, at least down at the Jersey Shore bars, are the iced
like the
tea,
white-
vodka,
Yeah,
the
yeah.
the White
The
Claws,
seltzers.
that
The
is
spiked
everywhere.
seltzers. Yes.
Yes.
Everywhere.
Yeah. It sort of reminds me of sort of the IPA trend and like craft beer, like 10 years ago?
Yeah.
That
It
was
reminds
everywhere.
me of what did we have growing up?
Zimas.
What did the
Zimas. Oh my
Zimas,
gosh.
yeah.
Malt beverage.
The wine coolers,
Boone's
those things.
Farm.
Yeah, wine coolers, like the peach
That's
wine
what
coolers.
the girls were drinking when I was
Yeah.
like in high school, college.
But now it's the hard seltzers
Yeah.
because some of them have zero sugar. It's
Right,
great.
but they have like really high alcohol content. They're
Do
like
they?
5-6% alcohol content. Yeah. Some are even more. I don't remember wine coolers having that much, or Zimas.
No.
God, Zimas. Do they still exist?
No, I don't
No,
know.
I can't imagine.
I don't know, but yes, I did used to enjoy
All right,
this.
that is the newspaper segment with Lisa Mateo. Thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.